Hi, guys. Welcome to today's session on concepts related to financial statements. I am Ken Enriquez, and I'm thrilled to guide you through this essential topic. Financial statements are the foundation of every organization's financial health and decision making process. They not only provide insights into how a business is performing, but also serve as a critical tool for stakeholders like investors, creditors, and the management. Whether you are a professional looking to enhance your financial acumen or someone new to the world of finance, understanding these concepts is a vital step towards making informed decision making. In this session, we will cover three main topics. One, the fundamental building blocks of the financial statements, starting with the accounting equation. Two, key concepts like the difference between accrual and cash basis accounting, the importance of materiality, and the idea of a business as a going concern. And number three, and most importantly, how these concepts impact real world decision making for individuals and organizations alike. By the end of our discussion, my goal is for you to not only understand these concepts, but also to see how they apply in practical scenarios, whether it is managing your own finances or evaluating an organization's performance. So let's dive right into the concept that form the very backbone of financial reporting. Ready? Let's get started. The accounting equation is the foundation of the double entry accounting system. It highlights the relationship between three critical components of the financial statements, which are the assets, liabilities, and the equity. Assets are what the business owns, like your cash, your inventory, and your equipment. Liabilities, on the other hand, are what the business owes, like loans or payables. Equity, on the other hand, are the owner's investment or the retained earnings in the business. Essentially, every resource a business has is funded either by borrowing or by the owner's contribution, which keeps the financial records in balance. Let's look at an example to bring this concept to life. In the first transaction, a business owner invests $10,000 into their business. Here is how it reflects in the accounting equation. The company assets will increase by 10,000 in cash, and since this is an owner's contribution, the equity will also increase by $10,000. Please note that no liabilities are involved in this transaction. So the equation remains balanced. Now, in the second transaction, the business takes out a $5,000 loan from the bank. The company's assets increase by $5,000 in cash. At the same time, liabilities increase by $5,000 because this is a loan that needs to be repaid. If we sum it all up, the total assets are $15,000, 10,000 from the owner's capital and 5,000 from the loan. Liabilities are $5,000 and equity is $10,000. Once again, the equation balances, which assets is equal to liability plus the equity. But how does this apply to real world decision making? Investors use this equation to evaluate the financial health of a company. For example, a company heavily reliant on liabilities might be riskier than one funded primarily by equity. Lenders like banks, assess the ratio of assets to liabilities to determine whether the business can repay its debts. Understanding this equation helps businesses track their finances and ensures transparency for stakeholders. It's not just numbers, it's a tool for smarter decisions. So that's the accounting equation in a nutshell. I hope this example helped clarify how it works and why it is important. Let's take a closer look at two fundamental accounting methods, the accrual basis and the cash basis. Understanding this is crucial for recognizing revenues and expenses in the financial statements. Under the accrual basis, revenues and expenses are recorded when they are earned or incurred regardless of when cash is received or paid. In contrast, the cash basis only records transactions when cash changes hands, when it's actually received or paid. Here is an example to demonstrate how these methods differ. Imagine a company delivers a service in December 2024 but does not receive payment until January 2025. Under the accrual basis, the revenue is recorded in December 2024 because that's when the service was performed, even though no cash was received. Under the cash basis, the revenue is only recorded in January 2025 when the payment is actually received. Now, let's look at an expense. A company receives an electricity bill for December, but the payment is made in January. Under the accrual basis, the expense is recorded in December 2024 when the electricity was used, even though payment has not been made. Under the cash basis, the expense is recorded in January 2025 when the payment is made. How does this impact decision making? The accrual basis provides a more complete and accurate picture of a company's financial performance and position. For example, it helps businesses track obligations like unpaid bills and recognize revenue that has been earned but not yet paid. This is particularly useful for long term decision making. On the other hand, the cash basis is simpler and might work for small businesses, but it can distort profitability. For instance, significant unpaid obligations might not be reflected in the reports, leading to an overly optimistic view of the company's financial health. By understanding the differences between these methods, you can better evaluate which approach suits a business needs or analyze financial reports more effectively. Let's move on to the next topic to build on this foundation. The going concern concept assumes that a business will continue operating indefinitely unless there is evidence suggesting otherwise, such as bankruptcy or liquidation. This assumption is crucial because it affects how financial statements are being prepared. Let's look at some examples to understand this concept better. If a company is in severe financial distress and likely to liquidate, its asset would be reported at their liquidation value, reflecting the amount that can be recovered during a sale rather than their historical cost. On the other hand, if the business is a going concern, assets are reported at their cost or fair market value, assuming they will continue generating value over time. The way assets are valued directly depends on whether the business is expected to continue operating. Now, how does this concept impact decision making? For auditors, they assess whether the going concern assumption is valid and that their audit opinion can significantly influence how stakeholders perceive the business. A qualified audit opinion indicating going concern risks might raise red flags. Investors. Investors use going concern uncertainties that might face declining stock prices as investors lose confidence. This is critical when making investment decisions. Suppliers often reconsider their credit terms if a company has a going concern risks, as they might worry about not getting paid. In essence, the going concern assumption affects not just how financial statements are prepared, but also how stakeholders like auditors, investors, and suppliers evaluate the company's financial health. Understanding this concept is key to interpreting financial reports effectively. With this knowledge of the going concern concept, you are now equipped to see how it shapes financial reporting and stakeholders' decision. Let's move forward to the next topic. Materiality refers to the significance of financial information in decision making. Information is considered material if its omission or misstatement could influence the decisions of the users of financial statement. In simple terms, materiality helps determine what matters most in financial reporting. Let's look at a couple of examples to understand this concept better. Imagine a company misclassifies a $1,000 expense in a report where the net income is $10,000. This error represents 10% of the net income, which is significant and could mislead stakeholders. This is an example of material misstatement. On the other hand, $100 misstatement in the same report might not be material because it only represents 1% of the net income. Materiality is context dependent. It varies depending on the size of the company, the nature of the error, and its impact on decision making. So, how does materiality relate to decision making? For investors, material information is crucial to making informed decisions. For instance, a material misstatement in revenue could result in overvalued stock prices, leading to misguided investment choices. For managers, materiality helps prioritize significant transactions and avoid wasting resources on immaterial details. This ensures the company focuses its efforts where it matters most. By understanding materiality, stakeholders can better assess the reliability and relevance of financial statements. It's a principle that ensures financial reports remain focused on what truly matters. Now that we have covered materiality, you can see how it plays a critical role in both preparing and interpreting financial statements. Let's move on to our next topic. Relevance is a key factor in assessing materiality. Simply put, information is considered relevant if it affects or influences decision making. Without relevance, financial data loses its purpose and value to users. Let's make this concept clearer with a simple example. Imagine you want to buy a brand new phone worth $1,000. However, you only have $999 in your bank account. In this case, the $1 difference becomes highly relevant because it determines whether or not you can purchase the phone. The small amount is material in this context because it influences your decision. Now, let's say you have $1,001 in your bank account. Here, the $1 difference is irrelevant because it does not affect your ability to buy the phone. It is not material to your decision making in this scenario. This example shows how relevance is context specific. A small amount might be significant in one situation but completely immaterial in another. In financial reporting, relevance ensures that users focus on information that truly impacts their decisions, helping businesses and stakeholders make informed choices. By understanding relevance, you can better evaluate financial data and its impact on decisions. That concludes our discussion on the foundational concepts related to financial statements. We have explored key ideas like the accounting equation, accrual versus cash basis, going concern, materiality, and relevance. These concepts form the bedrock of understanding financial reporting and decision making. Now that we have a strong foundation, we are ready to move on to the next topic, which is the set of financial statements and its elements. In this section, we will dive into the financial statements themselves, what they are, what they include, and how they help us assess an organization's financial health. Thank you for staying engaged, and I'll see you in the next session as we explore this important topic.